about some mortgage insurance. One of the big questions we get with clients, especially when we're looking at monthly payment, one thing that they don't really take into consideration when they're trying to do their budget is mortgage insurance premiums. So mortgage insurance premiums are really required on any type of loan. They're just done a little bit differently. Some of them are paid up front, some of them are paid up front and monthly, and some of them are just monthly. So let's talk about this, and I'll try to minimize it as quick as I can for you. So number one, let's talk about conventional loan. A lot of times people have that big conception they want to do a 20% down payment, and that is amazing. So first thing we look at is the conventional financing. When you do a conventional loan and you put 20% down, the mortgage insurance premiums go away. But let's really talk about what mortgage insurance is. Mortgage insurance protects the lender against the loan if you as a buyer were to default. So it's a less risk for us as a lender when you have a lower down payment requirements. We have mortgage insurance to help protect us in a default situation. So conventional loans, 20% down, no mortgage insurance premiums. Now, how mortgage insurance is factored on a conventional loan can be a couple of different ways, because it's very driven by the loan to value, how much money you're putting down. The more down payment that you put down, the lower the mortgage insurance premium is going to be. And also, the higher the credit score you have, the lower those mortgage insurance premiums are going to be. So in a win-win situation on a conventional loan, great credit scores are good and a pretty good amount of down payment. If it's 5, 10, 15, and then at 20%, we know it goes away. So those are kind of the trigger points, which will help you get you some lower insurance premiums if you are looking to go the conventional route. So let's talk about FHA. So FHA, we love FHA because it's not near as heavy credit score driven like those conventional loans, because it doesn't matter your credit score at all. It says here's the flat amount of exactly what you're going to pay into your mortgage as far as those premiums are concerned. But what FHA does is to help kind of reduce the monthly amount that they are charging you, they actually charge an upfront insurance premium. Now that upfront insurance premium is actually included into your mortgage loan. So it's not paid out of pocket as an expense at closing. It's actually included into your overall mortgage loan. So there's no extra out of pocket cost. It's just you're going to be paying it back through the life of the loan. Then the second one is that monthly mortgage insurance premium. So we have the upfront mortgage insurance premium, and now we have the monthly mortgage insurance premium, which is just like that conventional loan where it's paid on a monthly basis. The difference between FHA, though, is that FHA is going to require that monthly mortgage insurance for as long as you have this FHA mortgage. Where on that conventional side, once you reach the 20% equity, it goes away. So FHA a lot of times is a little discouraging because clients don't want to pay that mortgage insurance forever as long as they have this FHA mortgage. So what we get questions a lot of time is, can I refinance? Can I refinance off of that FHA mortgage and onto a conventional? Absolutely, you can. So we just run the numbers. We always want it to make sense. And then we can definitely look at refinancing you onto a conventional at some point later on if that is what you want to do and it makes sense for you. So let's talk about a couple others. VA, veterans. So if you are a veteran, we love VA loans because there's actually no monthly mortgage insurance. So it actually helps you with lowering your monthly payment than the other loan programs when you're doing less than 20% down if going to conventional. Then because that way now we can actually keep that payment as low as possible. Now, VA does have what's called a funding fee, which is kind of like their insurance. Okay, so remember on that FHA loan we had upfront mortgage insurance. VA will have a funding fee, and it's actually dependent upon if you've ever used your VA loan before. You're going to pay a higher funding fee if you've used your VA previously than if you've never used it before. Now, if you're a disabled veteran, you actually can get that waived where you may not pay a funding fee at all. So a veteran with a disability can have no funding fee and no monthly mortgage insurance, which is absolutely amazing. And then really the third most common or the fourth most common loan outside of those three would be a USDA loan. USDA loans are only for rural areas, and they're very specific because they have some income restrictions as far as how much income you make per year. The mortgage insurance requirements, though, are also a lot like the FHA side, where there is an upfront amount and there is a monthly amount. It's a little bit lower as a percentage than what it was on an FHA. And so, if for some reason, if you can do a USDA loan, if you're in that rural area and you qualify based off of the incomes, we definitely want to look at doing a new USDA loan. So those are the four main types of loans with mortgage insurance premiums and how they're different on each different one. And we want to look at all of those, look at what your long-term goals are when we're looking at getting you into the right loan product. I am here. Get these questions all the time. So anytime you have a question on this, you're not sure about what to do and what's going to be best for you, just give us a call, 972-840-3388.